Housing affordability is at the worst level we've seen in 40 years. The median home costs 5.5 times the median income. The historical average, 3.5 times. And here's what nobody's telling you. That's never sustainable. Something has to give. But here's the thing. I'm not going to sit here and fearmonger like every other YouTuber. Instead, I'm going to show you the 3 most likely scenarios based on actual data, the probability of each one, and exactly how to position yourself to win no matter which one plays out. I've closed over 50 million in residential transactions. I own 14 rental properties, and I've been tracking this market obsessively because my entire portfolio depends on getting this right. One of these scenarios is already starting to play out. Let me show you which one. Okay, so before I show you which scenario is playing out, you need to understand the 2 forces colliding right now. First, the affordability crisis. The median home costs $415,000. The median household income is $75,000. That's 5.5 price to income ratio. It should be 3.5 to 4 times. The monthly payment on a median home is $2,800. In 2020, it was $1,400. Here's what that looks like in real life. A family making $75K a year is spending $2,800 a month on housing. That's $33,600 per year. That's 45% of their gross income. After tax, it's closer to 60% of their take-home pay. They have almost nothing left for food, gas, savings, or emergency. One job loss, one medical bill, and they're done. And millions of families are in this exact situation right now. Second, inventory is rising while demand is falling. Active listings are up 35% year over year. Mortgage applications are down 30% from the 2021 peak. Translation, more homes for sale, fewer buyers who can afford them. So you have families who can't afford to buy and sellers who can't find buyers. And here's the part that will shock you. One of these 3 scenarios is already happening right now. The data proves it, but most people don't see it yet. Let me show you which one. Scenario 1 is the soft landing, and here's my controversial take. The Fed and the media want you to believe this is what's happening. I'm giving this one about a 35% probability. Here's what happens. Home prices flatten or decline 0 to 5% nationally. Some markets see 5 to 10% corrections, others stay flat. Interest rates gradually decline to 5.5 to 6% by late 2026. The economy avoids a recession, unemployment stays below 5%, and the market stabilizes by 2027. For this to happen, the Fed needs to cut rates again in December of 2025, then a couple more quarter-point rate cuts in 2026. That can potentially bring mortgage rates down to the mid 5% range. The job market needs to stay strong with unemployment below 5%. Wage growth continues at 3 to 4% annually, which helps people afford homes even at higher prices. And sellers need to slowly accept the new reality and drop their prices 5 to 10% to meet buyers where they are. Now, this has happened before. The 1990s, after the savings and loan crisis, home prices dipped 5 to 10%. Rates came down gradually and the market stabilized without a crash. The job market is still adding 150K jobs monthly right now. Consumer balance sheets are relatively healthy. Most homeowners have equity because they bought before 2022. So what do you do if this scenario plays out? Buyers, be opportunistic. The best deals are hiding in plain sight right now, especially in overbuilt markets like Austin, Phoenix, and Boise. Make more aggressive offers, use seller credits to buy down your rate, and focus on terms that make the numbers work today instead of waiting for the perfect time. Even in Utah, this is insanely applicable. Sellers, price realistically up front. Put more energy into presentation. Bad listings look worse in a slow market. Look for the best realtor. And of course, I'm biased, but guys, don't use the people that have this as a side gig. They make way more difference in a slower market, the good agents. Expect a longer time on market, 60 to 90 days instead of 30. Now, for investors, focus on sustainable deals. Assets that perform in the short term but compound in the long term. Strong markets, quality tenants, and the right financing matter more than chasing the cheapest price. Blend cash flow and appreciation potential for balanced returns. But here's what I actually think is happening right now. We're not headed for a soft landing. We're already in the early stages of scenario 2, and I can prove it with 3 data points. Let me show you. Scenario 2 is the correction. and I'm giving this a 50% probability, the highest of the three. Here's what happens. Home prices decline 10-ish% nationally over 18 to 24 months. Overheated markets see up to 20% drops. Interest rates stay elevated at 6 to 7% through 2026. We get a mild recession in 2025 into 2026. Unemployment rises to 5 to 6%. Forced sales increase as overleveraged investors and homeowners who bought at the peak can't hold on anymore. The market bottoms in late 2026 and recovers slowly in 2027 to 2028. And here's why I think we're already in the early stages of this. Proof point number one, active listings are up 35% year over year nationally. Austin is up 60%. Phoenix is up 55%. Boise is up 50%. That's not normal seasonal variation. That's distress. Proof point number two, price reductions are at 40% of all listings nationally. In Austin, Phoenix, and Boise, three markets that are struggling right now, it's over 50%. Sellers are panicking. Proof point number three, pending home sales are down 20% year over year. Mortgage applications are down 30% from the 2021 peak. Demand is collapsing. Those 3 points tell me we're already in the early stages of the correction. For this to fully play out, we need a mild recession triggered by high rates and consumer spending pullback. The Fed keeps rates higher for longer because inflation stays sticky around 3 and 4%. Unemployment rises to 5 to 6%, not catastrophic, but painful. Overleveraged investors start panic selling because they can't cover negative cash flow anymore. This looks a lot like 1990 to 1991 recession where the home prices fell 10 to 15% over 18 months. The difference now, affordability is worse. We have more overleveraged investors and we have rising inventory in key markets. Now, not all markets will correct the same. Severe corrections, up to 20% drops, I'm guessing Austin, Boise, Phoenix, different parts of Florida, these saw 50 to 70% appreciation and are now oversupplied. Moderate corrections, I'm thinking 10% drops, Denver, Salt Lake, Nashville, Charlotte, markets that saw 30 to 50% appreciation. Mild correction, the 5% drops, LA, New York, Chicago, Boston. Supply-constrained markets with strong job growth. The key is knowing which market you're in. Buyers, don't try and time the market. Time in the market always wins. Be aggressive with your offers, especially on listings that have been sitting. Use seller credits to buy down your rate and negotiate strong terms. Focus on deals that make sense today and still pencil if prices drop another 5 to 10%. Sellers, you need to price aggressively and stay flexible on terms. Serious buyers are out there, but they're value hunting. If you can hold long term, focus on preserving equity rather than chasing top dollar. Now, investors, this is when real wealth gets built. Identify distressed or tired sellers and structure creative finance terms. Lock in fixed rate debt, prioritize positive cash flow, and look for upside in value or rents. You don't need to wait for a crash, just buy intelligently. Now, I know what you're thinking. Tanner, you're fear-mongering. A crash isn't going to happen. But here's the truth. There are 4 specific triggers that could turn scenario 2 into scenario 3 overnight, and one of them almost happened last year. Let me show you. Scenario 3 is a full-on crash. And here's the truth. This scenario is more likely than the mainstream media wants you to believe. I'm giving this about a 15% probability, the lowest, but if you ignore it, you could lose everything. Here's what happens. Home prices decline 30% nationally over 24 to 36 months. Some markets see 40% plus drops, 2008 type correction. We get a severe recession with unemployment at 7 to 9%. Mass layoffs across industries, wave of foreclosures, and forced sales. Credit tightens significantly, banks stop lending, mortgages become harder to get. The market doesn't bottom until 2027, 2028, and recovery takes 5 to 7 years to get back to 2024 price levels. So what could trigger this? Let's look into it. Trigger number 1, severe recession. Unemployment spikes to 8 to 9%. Mass layoffs, consumer spending collapses, housing demand evaporates, foreclosures surge. Trigger number 2 is the credit crunch. Banks dramatically tighten lending standards. Even qualified buyers can't get mortgages. In a lot of circumstances, cash might be the only way that you can buy. Trigger number 3, geopolitical shock. Major war, pandemic, energy crisis, global financial crisis that spreads to the US. Trigger number 4, policy mistake. Fed keeps rates too high for too long, triggers a deep recession. And here's the scary part. Trigger number 2 almost happened in 2023 when Silicon Valley Bank, Signature Bank, and First Republic failed. The government stepped in with emergency measures to prevent a credit crunch. So what happens if they don't step in next time? Now here's why this is less likely than 2008. No subprime crisis. Lending standards are much tighter today. Homeowners have equity, most bought before 2022 with low rates. The government learned from 2008, intervene faster. Demographics. Millennials are in the prime home buying years. Supply constraints were not overbuilt nationally like 2008. In fact, we actually need to build a lot more homes. But it's still possible because affordability is worse than 2008. The price to income ratio is higher now than it was at the 2006 peak. If unemployment spikes and people lose jobs, they can't make payments no matter how much equity they have. Buyers, don't try and time the bottom. Focus on buying smart. The best opportunities will show up when fear peaks. Strengthen your cash position, line up financing, and be ready to strike when the deal makes sense. Prioritize job stability and strong fundamentals over perfect timing. Sellers, be proactive and realistic. If you need to sell, price ahead of the market and focus on clean terms to attract serious buyers. If you can hold long term, protect your equity and keep your expenses low until the market stabilizes. Investors, downturns create the biggest wealth transfers. Stay liquid and alert. Distressed deals and motivated sellers will emerge in every market. Focus on prime locations, solid fundamentals, and conservative financing. Don't wait for headlines to say bottom. Buy when the math and the opportunity align. So those are the 3 scenarios. But here's the $1 million question. How do you know which one is actually happening? Because if you guess wrong, you could potentially lose everything. Let me show you the 3 leading indicators that will tell you exactly which scenario is playing out before it's obvious to everyone else. So how do you know which scenario is actually happening? Indicator number 1 is the unemployment rate. Below 5%, soft landing is likely. 5 to 6%, a correction is likely, and above 6%, crash risk is rising. Right now, we're at 4.2%. Watch this closely. If it crosses 5%, we're moving from soft landing to correction territory. Indicator number 2 is housing inventory. 4 to 5 months is a balanced market. 6 to 8 months on the border of correction. 9+ months, we are at risk of a crash. Right now, most markets are at 5 to 6 months and rising. If we hit 7 to 8 months by mid-2026, correction is confirmed. Indicator number 3, price reductions. 20 to 30% of listings is normal. 40 to 50% correction is underway. 60% plus crash conditions are here. Right now, we're at 40% nationally, 50% plus in Austin, Phoenix, and Boise. This is already correction territory. Now, here's what I'm watching most closely. If unemployment crosses 5% and inventory hits 7 to 8 months and price reduction hits 50% nationally, we're moving from scenario 2, correction, to scenario number 3, a crash. Now, here's the part where I tell you something you're not going to want to hear, but it could save you hundreds of thousands of dollars. Let me show you the one thing you need to do right now, no matter which scenario plays out. Okay, so here's the bottom line. Soft landing, 35% probability. Correction, 50% probability. A crash, 15% probability. But here's the thing. You don't need to predict which one will happen. You just need to prepare for all 3. And here's the one thing you need to do right now. Build cash reserves. For buyers, make sure you have at least 6 months of reserves before jumping into a home. You don't need a massive down payment. What matters is having runway and stability so you can handle surprises without stress. If you're a seller, you need 6 to 12 months of living expenses saved in case your property takes longer to sell. If you're an investor, you need 12 to 24 months of operating expenses saved so you can weather a downturn and buy when everyone else is panicking. Because here's the truth, cash is king in every scenario. In a soft landing, cash lets you negotiate better deals. In a correction, cash lets you buy at 20% plus discounts. In a crash, cash lets you buy generational wealth. And here's what I've learned from my mentors who have gone through multiple market cycles. Fundamentals always win. Speculators get crushed in corrections. Operators who focus on cash flow survive and thrive. Operators who focus on deals that make sense today will survive and thrive. If you buy properties that cash flow today, if you use conservative financing, if you have cash reserves, you'll be fine no matter which scenario plays out. Prepare, don't panic. Build your knowledge, build your cash reserves, watch the indicators, and be ready to act when the opportunity comes. The best deals happen when everyone else is scared. And if you don't believe me, ask Warren Buffett. If you want more breakdowns like this, hit subscribe. I send out a free monthly newsletter with real market data here in Utah. No BS, just numbers. Link is in the description. Drop a comment and let me know, which scenario do you think is most likely, and are you buying, selling, or waiting? Remember, discipline beats motivation every single time. I'll see you on the next one.